Welcome to Mayor Brown's Global Financial Markets Podcast. Each 30-minute episode is designed to help listeners better understand the legal issues that impact their business given the ongoing uncertainties in the financial markets worldwide. Speakers from across Mayor Brown's practices and offices provide their timely insights on a wide range of topics, including finance, financial services, and insurance regulatory developments, securitizations, and litigation in the United States, the United Kingdom, Europe, and Asia. We hope you enjoy the program.
Hello, listeners. Our topic today is U.S. government policy and bank regulatory developments. My name is Jeff Taft. I'm a partner in Mayor Brown's Financial Services Regulatory and Enforcement Practice in the D.C. office. Joining me today are two Mayor Brown partners, Matt Bazance and Andrew Ullman. Matt is also a partner in Mayor Brown's Financial Services Regulatory Enforcement Group, and Andrew is a partner in Mayor Brown's Public Policy, Regulatory and Government Affairs, and the Financial Service Regulatory Practice. As I'm sure you all recall, over the course of a weekend in March, Silicon Valley Bank and Signature Bank were closed by federal and state banking regulators. To avoid imposing losses on uninsured depositors, the FDIC utilized the systemic risk exemption. The systemic risk exemption is an exemption to the least cost resolution requirement for failed banks and allows the FDIC to act to avoid the potential adverse effects of a major bank failure, even if it's not the least costly way of resolving the bank. While the U.S. banking system has seen many bank failures, the size of these two banks and their rapid collapse left many observers, regulators, and politicians wondering what happened. What happened has been the subject of many reports, hearings, and discussions. These failures have also resulted in some lingering instability in the U.S. banking system, causing significant swings in share prices of several banking organizations and the acquisition of Republic Bank by JP Morgan in early May. Today, we are going to discuss some of the reports and the possible longer-term impacts of these failures from a legislative, regulatory, and accounting perspective. While some of the potential regulatory changes may be foregone conclusions, others will play out over time and be the subject of contentious debate over the coming months. We will also consider accounting rules and changes to those rules. With that said, I'll turn the program over to Andrew, who's going to discuss the congressional response and the FDIC proposals to replenish the Deposit Insurance Fund. Andrew?
Thanks, Jeff. The resolution of Silicon Valley Bank and Signature Bank has certainly attracted the attention of Congress. This is due to the fact that federal financial regulators invoked their emergency authority under the systemic risk exception to resolve those institutions. Although such emergency action was undertaken to prevent a larger run on the banking system, the cost to the FDIC is estimated to be nearly $16 billion. It's therefore not surprising that Congress has lost no time in conducting several oversight hearings on the supervision and regulation of those banks. During those hearings by both the Senate Banking Committee and the House Financial Services Committee, members of Congress also sought to determine whether any legislative reforms are needed. The two issues that Congress has focused on so far are, one, whether the FDIC deposit insurance needs to be reformed, and two, how to enhance the accountability for executives responsible for the failure of a bank. With respect to deposit insurance reform, Congress has so far not moved any legislation. However, the FDIC has produced a very thoughtful and balanced report on potential options for deposit insurance reform, which I think signals how Congress might approach the issue. The FDIC's report emphasizes that any deposit insurance reform needs to balance the competing policy goals of enhancing financial stability and minimizing moral hazard. The report noted that expanding deposit insurance can help reduce bank runs and promote financial stability following a financial shock, such as a bank failure. But deposit insurance can also undermine incentives for depositors to monitor the risks that bank executives assume and therefore could ultimately increase losses to the FDIC. Although the FDIC did not provide a formal recommendation, the report implicitly suggests that Congress should at least look into taking a targeted approach to deposit insurance reform, such as expanding coverage to transaction accounts for businesses. This would reduce incentives for small businesses to quickly withdraw their deposits at the first indication of a possible problem with their bank in order to make sure they can make payroll. This more focused approach to deposit insurance reform so far has gained the most interest from members of Congress, though again, a legislative effort is not on the immediate horizon. Instead, Congress has focused on increasing the accountability of senior bank executives. Recently, the Senate Banking Committee passed the Recoup Act, which would authorize the FDIC to claw back the compensation of senior bank executives whose bank is placed in an FDIC conservatorship or receivership and who are responsible for its failure. The FDIC would have the authority to claw back compensation, including incentive-based compensation, equity-based compensation, severance pay, golden parachute benefits, as well as any profits realized from the purchase or sale of securities of the depository institution or its holding company during the prior 24 months preceding the failure of the bank. This clawback provision would only apply to banks with $10 billion or more in assets. The new legislation also would require banks and bank holding companies with $10 billion or more in assets to adopt new governance standards that, quote, promote safety and soundness, responsiveness to supervisory matters, and responsible management. These standards must include policies for senior executives and board members regarding risk management and responding to supervisory matters, as well as accountability and corporate governance mechanism controls, such as directives that senior executives and board members implement and oversee reporting systems and controls, and that management does not deviate from sound risk management. These new governance standards have not received much attention yet, but they potentially represent, if enacted, a significant expansion of regulatory oversight of bank management and governance. Another aspect of the Recoup Act that has not received much attention is its expansion of the banking regulators' removal and prohibition authority. Unlike the clawback provision and governance standard provisions, the removal and prohibition provision would apply to any bank. Under these provisions, banking regulators could remove from office and prohibit from employment in the banking industry any senior executive who fails to carry out his or her responsibilities for governance, operations, or risk management, where the senior executive's failure demonstrates gross negligence in the performance of his or her duties, and where such action results in the bank suffering a financial loss, prejudices the interests of depositors, or results in a financial gain for the executive. The bill would also grant federal banking regulators authority to remove a senior executive from office who engages in certain conduct, including breaching a fiduciary duty in a manner that involved grossly negligent, reckless, or willful conduct, fails to appropriately implement financial risk supervisory reporting or information system or controls, or fails to oversee such a system or controls once they're implemented. In addition, the Recoup Act would prevent banks subject to the 10% deposit cap from acquiring failed institutions unless the bank was the only bank that applied to purchase the failing institution, and the acquisition would prevent federal financial regulators from invoking the systemic risk exception. The Recoup Act was passed by a vote of 21-2, but its future is uncertain right now. The House Financial Services Committee has not yet signaled that it plans to take up the legislation. I want to turn quickly now to the FDIC, which is also involved in its own form of recouping. Because the FDIC incurred an estimated loss of $15.8 billion to resolve Silicon Valley and Signature banks, it recently proposed a special assessment to be levied to replenish the deposit insurance fund. Under the proposal, assessments will be based on the amount of a banking organization's uninsured deposits as of December 31st, 2022, excluding the first $5 billion of uninsured deposits. The rate of the assessment would be approximately 12.5 basis points. The assessments would start in the first quarter of 2024 and last for approximately 8 quarters. However, the assessments could be modified based on how much the FDIC ultimately pays out in the resolutions of Silicon Valley Bank and Signature Bank. The proposal effectively exempts all institutions under $5 billion in total assets. The FDIC estimates that 95% of the assessments would be paid by banking organizations with $50 billion or more in assets. The comment period on the proposal ends on July 21st. With that, let me turn it back to you, Jeff.
Thanks, Andrew. On today's update, I'm going to cover the Fed's review of the supervision and regulation of SVB and its implications going forward, and then briefly highlight the FDIC's review of Signature Bank's failure. On April 28th, the Federal Reserve Board released the results from its review of the supervision and regulation of SVB led by Vice Chair for Supervision, Michael Barr. The report's over 100 pages, and the FRB posted various supervisory materials on its website, including 31 unaddressed supervisory warnings, which the bank had at the end of 2022, which is detailed in Table 2 of the report. As Federal Reserve Board Governor Michelle Bowman noted in her recent remarks, although the report was published by the board, it was a product of one board member. It was not reviewed by the other board members prior to publication, and the board members really weren't afforded any opportunity to comment or contribute to the report's contents. In some circles, this has created some concerns about the takeaways in the report and whether another independent review would help address the impartiality and independence of the review. With this background, though, let's kind of discuss the findings and some of the potential impacts they may have. The review effectively identified 4 key reasons for the failure of SVB. First, SVB's board and management failed to manage their risks. 2, Fed supervisors did not appreciate the extent of the bank's vulnerability as it grew in size and complexity. Third, the Federal Reserve did not take sufficient steps to ensure that identified vulnerabilities were fixed quickly enough. And finally, tailoring approach in response to the Regulatory Relief Act, in fact, impeded effective supervision of SVB by the Fed. I think the first 2 points about the management and the failure to understand the vulnerabilities are pretty self-evident. I think everybody's kind of in agreement that there was some mismanagement and certainly some failure by the Fed to understand certain things. I think the third and fourth point, though, in the report are the ones that have drawn a fair amount of criticism from the industry, House Financial Services, and others, including Governor Bowman. As noted above, there were 31 unaddressed supervisory warnings, MRIAs or MRAs, that remained open at the end of 2022. The number seems high and potentially significant. I think, though, when you take a deeper look at the MRIAs, of those 31, only 6 or 7 really focused on liquidity and interest rate risk. Therefore, while there were a high number of unaddressed matters, few related to the things that would ultimately lead to the bank's failure a couple of months later. I mean, it's possible that a number of these findings may have actually distracted management or the regulators away from what were the truly important items in the MRAs and MRIAs that remained at the bank. I think while the third point is interesting and it's certainly something that's been debated, I think the fourth point is really going to have the most important impact from a supervisory perspective as we move forward, and the Fed takes steps to address the perceived shortcomings of the current oversight model, including capital and enhanced prudential standards. I mean, as many of you know, the Regulatory Relief Act in 2018 raised the asset size threshold for application of enhanced prudential standards from $50 billion to $250 billion. In 2019, the Fed basically adopted a tailoring approach, a regulation to implement the Relief Act. The tailoring rules generally reduced or delayed a higher level of regulatory oversight at banks of a certain size, which would have included the size of SVB at the time of its failure. These categories included the liquidity management, certain capital requirements, and enhanced stress testing. While the Relief Act provided relief to certain institutions, it also provided the Fed with the authority to apply the enhanced prudential standards to banks between $50 billion and $250 billion in assets. As some have noted, this would have allowed the Fed to impose additional requirements on SVB or any similar bank, even if it fell below the $250 billion asset threshold, if there was a genuine concern on behalf of the Fed. The fourth point in the report effectively is ensuring that discussions with the Fed and outside of the Fed will focus on the tailoring rules in effect at the time of the failure of Silicon Valley Bank. While the Regulatory Relief Act has been a somewhat convenient scapegoat for the SVB failure, it's certainly not clear that it really played an important or significant role in the bank's failure ultimately. As many have highlighted, neither the Regulatory or the Relief Act nor the Fed's tailoring rules precluded the Fed from exercising additional supervision over SVB. While it may have required some specific action by the Fed, we all agree that it was possible and they could have been taken those steps. While the likely changes are not entirely clear, you can certainly expect that the tailoring rules will be adjusted and more banks, including Category 3 and 4 banks, will be covered under the future regimes. Furthermore, the Fed's review and these recent failures will likely impact the soon-to-be-released revisions to the Basel capital standards. As people are aware, the federal regulators have been drafting rules for the Basel endgame. While the rules have been expected for months, the actual release date remains somewhat uncertain. While the general public's probably more interested in the Taylor Swift concert series, the industry eagerly awaits the release of these rules. We understand that the release will likely be issued within the next 2 or 3 weeks. The initial public reports and regulatory statements regarding the new capital rules have indicated that certain banks could face substantial increases in their capital, up to 20%, some say. While we don't know whether these reports are accurate, we can only assume that these are test balloons that are being floated so that the industry is prepared and that stakeholders understand what's coming. While some policymakers and pundits have called for higher capital considering the failures of SVB and Signature, there is significant evidence that these failures were more idiosyncratic than systemic problems with capital held by banks, including other banks besides Silicon Valley and Signature Bank. Obviously, imposing higher capital standards across the board on all larger banks based upon the failure of these two institutions could be viewed as a knee-jerk reaction at this stage of the process. As with any increased regulation, there are costs imposed on the industry and there are costs imposed upon the broader economy. The regulators are also likely looking at imposing some additional enhanced prudential standards on a wider range of institutions. They could, for example, impose additional or annual supervisory DFAST stress tests and full LCR and full NSFR requirements on a wider range of entities, including Category 3 and Category 4 institutions. In addition to the enhanced capital and liquidity requirements, the recovery and resolution planning requirements could also be imposed on a number of institutions. For example, banking organizations with $100 billion or more in assets could have annual obligations again with respect to resolution plans. There are a number of possible outcomes. The regulators will ultimately determine the scope and size of these actions, but they will obviously be influenced by the events of the past few months. Before turning the program over to Matt, I did want to briefly switch from the SVB review by the Fed to the FDIC's review of Signature Bank. The FDIC conducted a post-failure review and on April 28th released its report detailing its supervision of Signature Bank. While the takeaways here aren't likely going to have the same implications for the industry as the Fed's with respect to SVB, they're probably worth a minute or two just to kind of cover. The FDIC review identified several causes of the bank's failure, including over-resilience on uninsured deposits and the loss of liquidity. It also noted that rapid growth without commensurate risk management practices and that management was not responsive to supervisory findings. Much like the Fed, the FDIC also noted numerous shortcomings in its supervision of Signature Bank. Ultimately, the FDIC identified 13 areas for further consideration or study. These included enhancements to examination guidance for institutions that are over-reliant on uninsured deposits, enhancements to the examination process to assess liquidity risk management, and increases to FDIC staffing and resources. Interestingly enough, the FDIC staffing and resources covered 5 of the 13 points in the FDIC report. These supervisory shortcomings ultimately played a large role in the failure to properly supervise Signature Bank, and it's something the FDIC has indicated is a step that needs to be resolved in the future going forward. With this quick overview of the regulatory reports, let me turn it to Matt, who's going to discuss some of the accounting implications arising from these recent failures. Matt?
Jeff, thank you for those comments. Now, one aspect of the recent banking crisis and the expected regulatory response has been the role that accounting plays in bank balance sheets and bank activities. Accounting generally reflects historical cost of an asset or a liability. And in some cases, if there's an impairment to that asset's value, accounting will write down that historical cost to recognize the diminution in value. This is based on the conservatism principle that it's better to look to the historical cost, which is a known definite figure, instead of trying to estimate it based on subjective factors that might change or be more optimistic than is really the case. However, in recent decades, most recently in 2010, there has been a push to mark at least certain assets on bank balance sheets to fair market value, or known as mark-to-market accounting. This is looking at the issue from a different perspective of users of financial statements are looking at the current economic reality of an organization. And historical cost, while highly accurate, may not be reflective of current economic reality. That a piece of land purchased in 1920 for $100 is certainly worth more than that today. And while the historical cost on the balance sheet would be $100, an organization that had land from 1920 that it paid $100 for is sitting on a huge unrealized gain. Therefore, some could argue, well, we should mark assets to fair market value. The difficulty in doing so is that it may not be readily ascertainable or accurate, and even if it is readily ascertainable and accurate, there may be high degrees of variability that, as we've seen in recent months, the market value of a bond may change solely based on changes in interest rate, that nothing with the credit worthiness or expected repayment by the issuer, but merely based on the availability of other instruments that are paying a higher interest rate can cause existing instruments to decline in value. And so that variability relative to interest rates is one reason why some people are against fair market value. But where does this come up? So with Silicon Valley Bank and others in this crisis, they had on their balance sheet securities that were held at historical cost. And those securities had lost value on a fair market basis, but because of this accounting principle that I just talked about, they were not required to write these assets down. Now, if that was the case universally, that one could argue, well, that's just a universal constraint of accounting. But there is a different way, and this is what is known as the available for sale versus hold to maturity distinction, that securities that are available for sale will be marked to market on an ongoing basis, reflective of either tier 1, 2, or 3 inputs. In contrast, hold to maturity securities are kept only at their amortized historical cost. And the theory here being that if securities are available for sale, then it is possible, even likely, that an organization will sell them, and so any unrealized losses or gains would need to be passed through to the balance sheet. In contrast, hold to maturity securities should be held to maturity, in which case the organization is likely to receive back the face value of them, and so the current market value really is not a relevant attribute. The other piece of this is that hold to maturity securities in many ways are thought of as being similar to loans that a banking organization might make. And while you can argue that hold to maturity securities are likely to have some indicia of fair market value that you could assess, it is much more difficult to assess the fair market value of loans. And therefore, it would result in inconsistent treatment, that you have a mortgage-backed security that you are holding to maturity for 30 years and you are marking that to market, versus a 30-year mortgage that you've made that you are not changing. And so that inconsistent value is another reason why hold to maturity securities are treated more like loans than they are available for sale securities. Similarly, a hold to maturity security can't be hedged with hedge accounting. Instead, only available for sale securities can be hedged with hedge accounting. But this is just an accounting lesson. That the way this came up was in 2022, Silicon Valley Bank had a significant number of mortgage-backed securities and treasury securities in its available for sale book. And these securities had interest rate hedges on them that allowed them to be allowed the Silicon Valley to be insulated from changes in rates. Now, in order to recognize certain gains that had occurred on those hedges, Silicon Valley rebooked those available for sale securities as hold to maturity, and saying, in effect, we thought we might trade these securities at some point, but now we're planning to hold them forever, and so we don't need to We don't need to be adjusting their fair market value, and we in fact can't do hedge accounting to recognize the value of the interest rate hedges, so we're going to close those out. That resulted in a problem when in 2023 interest rates continued to go up, and so those securities became worth less, and that decline in value wasn't marked on Silicon Valley Bank's books. This resulted in an implied loss, or a not a loss that was not apparent looking at the balance sheet. You could see in the notes that on a fair market value basis, Silicon Valley was actually veering towards insolvency, but because of the historical cost basis, it wasn't apparent. So after Silicon Valley Bank, there were some thoughts of, well, there's a few ways we could fix this. One is get rid of hold to maturity. Everything is marked to market, just like available for sale, and that way banks can't have these losses that are not obvious to investors. Another thought has been, well, we could allow hold to maturity securities to qualify for hedge accounting. So that would encourage banks to place interest rate hedges on their long-term securities holdings, because they would actually be able to recognize the mitigating effect of those hedges in their accounting statements. There are other ideas, such as saying, well, all of these losses, both in the available for sale and hold to maturity book, those should really be even a flow through for smaller banks like Silicon Valley and those smaller than it. And so we should get rid of the opt-out under the regulatory capital rules that allows smaller banks to opt out of recognition of changes in value on available for sale securities. This would be quite controversial given the size of both the hold to maturity book losses on bank balance sheet, but also the available for sale losses that smaller banks have, who typically don't have as many options for trading or getting out of positions. But this is something that people are considering, saying, well, look, we should change the accounting to address the hold to maturity issue, but we should change the capital rules to address the AOCI opt-out issue. And I think we're going to see changes, at least the AOCI opt-out in the pending capital rules. I think hold to maturity changes are probably a bit longer term, because they would have such dramatic effects on the balance sheets of banks large and small. However, all of these changes, even if banks were managing them well, the other part of accounting that is not necessarily apparent, and I think we saw this with First Republic in true form, was that even if banks have sufficient capital to pass through losses on either an unrealized basis from hold to maturity securities or on a mark-to-market basis from available for sale securities, there still is intense compression of the net interest margin. This is in accounting terms, this is the difference between the interest a bank earns on its loans versus the interest a bank pays on its deposits. And because deposits are a liability of the bank and they aren't and really can't be marked to market, you kind of see them as a never changing constant, but they do change. That in order to maintain that amount of deposits on a bank balance sheet, it needs to pay higher and higher interest rates in an increasing interest rate environment. In contrast, the loans continue to pay the same interest to the bank on regardless of how time passes. And so if there's an increasing interest rate, that while the value of the loans will go down, the interest rates will remain constant. And this creates a compression as the deposit interest rate hits and surpasses the loan interest rate. And so while you can say we need more capital to deal with the unrealized losses in the loan book, there really isn't a good accounting solution for dealing with the increased interest paid on deposits that is compressing the net interest margin, or the NIM margin. And I think this accounting problem is much more difficult to solve because it is a structural problem. And so in the case of First Republic Bank, they did not need to liquidate their hold to maturity book. They were able to survive the March crisis. They had the infusion of deposits from the other big banks, but they started to run into the issue where the interest they owed the Federal Reserve for the use of the discount window in the bank term funding facility, that resulted in such a compression of their net interest margin that I think it was likely at some point they received an earnings downgrade from the banking regulators, at which point they were ineligible to use the discount window. And that's really what precipitated their failure, was their earnings ability declined due to the compression of net interest margin. And so while they were still solvent, and unlike Silicon Valley Bank, they didn't have a huge unrealized loss that was obliterating their balance sheet, they did have a compression on the income statement that put their ability to continue in doubt. And so this one, while you could say, well, we can solve it with the discount window, that's a short-term solution, because again, unlike it's similar to a deposit. It is like a deposit that you're now paying the Federal Reserve interest versus paying a depositor interest. And so that kind of compression on the account from the accounting side is something that is going to continue to be a debate. And unfortunately, I don't have a lot of good solutions to it, but I'm sure there will be some smart minds out there thinking of them. With that, I would like to thank everyone who has tuned into this GFM podcast. We really appreciate hearing from you. If you have any questions or comments on the program, please feel free to email us at gfm@mayorbrown.com. Thanks and have a great day.
We hope you enjoyed this program. You can subscribe on all major podcasting platforms. To learn about other Mayor Brown audio programming, visit mayorbrown.com/podcasts. Thanks for listening.